Hello and welcome to Business Incorporated. I'm Ini John Merkwa. Well, let's begin as usual with market numbers here in Africa. Nigeria's all-share index is still bearish from yesterday as intraday was down 0.2%, considering yesterday's close in the red, but hopefully profit-taking reduces. Meanwhile, in South Africa, the Jersey is on a bullish run with over 1%. In North Africa, Egypt is also looking good, up 0.20%. As intraday, while the East African biggest market, Kenya, closed Monday straight positive, 0.23%. In the Middle East, now major markets were trading in the positive territory. Abu Dhabi was up 2%, while Dubai was up more than 1.5%. In other regions, Saudi Arabia was the biggest loser, over almost 2%, shaved off its share index, while Qatar was up over 1%. Let's go to Europe now, where the European Union has slashed growth forecast, and that's because of the war going on in Ukraine and the effect on energy supplies. The 27-nation bloc now anticipates growth of 2.7% this year, and that's down from the prior forecast of 4%. And stable energy supplies, costs threatening to bite down, especially hard into growth. Well, we'll have Stephen Beardsley now joining us from Berlin to give us the details. Hello, Stephen. So this is the EU's first growth forecast since the start of the war. What else have you learned apart from this downgrading of the growth forecast?
Well, we've had confirmed in numbers what we pretty much already knew, and that is that the war is taking a big bite out of EU growth and EU potential. This was supposed to be a year of more expansive growth because it was supposed to be a recovery year after 2 years of pandemic. It was supposed to be a year in which economies began to recover. And instead, what we've seen is that there are new issues with markets for European businesses, that is Ukraine and Russia, now pretty much offline. It's also an issue for, we're also seeing issues with supply, and then, of course, the big one is with energy. Now, there already were some energy concerns before the war began. That was largely due to tightness in the market for things like gas, for example, as Asia, for example, demanded more LNG. So prices were already going up, but now it's really come down much more seriously since the war. And that, in turn, has driven up prices. So we've already seen prices rising high throughout the EU. For the whole year, they're now projected to be in a range from 4.5% in Portugal to 12.5% in Lithuania. That gives you an idea of what it looks like across the range of 27 nations. That means for a total, for an average inflation of 6%, more than 6%. So that's pretty considerable. That bites into business bottom lines and also pushes up interest rates. That forces central bankers to raise interest rates, and that further cuts into bottom lines.
I mean, look, beyond this, does the outlook change? I mean, from after this year?
No, in fact, it's not. The EU is now expecting 2.3% growth for next year. That would be lower than what they're projecting for this year. And the primary reason for that is that a lot of the economic dynamic that we saw last year coming into this year will be gone by 2023. Inflation, however, should abate somewhat. And that's the hope, at least, that it should settle down to closer to an average of around 2.7%. Now, keep in mind that the ECB has a goal of 2%, so that's still above the ECB goal for inflation long term. You know, the question is really how the war is going to develop and how energy embargoes against Russia are going to develop. Will Europe find enough replacement for gas and for oil to keep their businesses running, to keep costs low? That's going to be a question. There is a fear here that there's going to be perhaps longer-term low growth and high costs. The Hungarian Prime Minister Viktor Orban saying yesterday, he warned of an era of recession. Now, of course, he's not quite the most moderate voice in the EU, but he's giving voice to a fear that you're going to hear more and more here.
Yeah, you can say that again. And how's the market taking all of this? What's the outlook, or how's the market doing at this time?
Well, we saw yesterday that markets were somewhat down based on the data coming out of China, that triple hit of low factory output, low retail sales, and rising employment, that causing some uncertainty amongst European markets. What we're seeing right now is that there is a bit more optimism today. In the UK, for example, good unemployment numbers have boosted markets there. We're also seeing markets rise in London and, in Paris and in Frankfurt. There's going to be a lot of eyes on what's coming, of course, for today and what's coming in the week ahead, especially as with developments in the war and with further economic growth numbers. The EU is expected to reveal first quarter numbers later today. That could also play into sentiment.
All right, Stephen, thank you so much for that updates from Berlin. Now, let's move to the UK now. And the talk of inflation seems to kind of run away. Somebody just said that one thing that economists cannot beat these days is inflation. In Nigeria, yesterday, we had our inflation out, and it was up 90 basis points. Very high, I would say. Well, we have Juliana joining us now as we expect UK inflation tomorrow. To paint a picture, if we're really going to hit that double digits we've been talking about in the UK, Juliana, do you see that?
Good afternoon, Innie. Well, yes, we do have the inflation figures out tomorrow from the Bank of England. Lots of talk about the cost of living. And, of course, the cost of living is really reflected by that metric. It's currently at 7%. A couple of weeks ago, the Monetary Policy Committee forecast that it could reach double digits by the end of the year. But according to City economists, they're expecting inflation tomorrow to come anywhere between 8.9 to 9%. So that double-digit figure is getting much closer than we think. And now, cross-party MPs actually called Andrew Bailey, the Bank of England governor, to come and talk about that really gloomy outlook and the picture he painted of even more hardship to come for British families. This is all being underlined with the statement we had by the CBI chair earlier this morning, asking the Chancellor Rishi Sunak to do more to help families, that it is a moral imperative of the government. And there's just so much data, Innie, coming out from charity groups, from opposition parties. And I think everybody in the UK at the moment is feeling the pinch because prices are going up so fast. Even though the official data says 7%, it does in some aspects feel like it is 50%. So again, wait and see, a buzz term in the business world, but we do have to wait and see. But certainly, if we don't get to double digits for the month of April, which is what the forecast, which is what the data tomorrow will tell us, definitely by May or June, it could come.
Yeah, double digits, scary, but reality for this time. And, well, away from that, it seems for the very first time that there are more job vacancies than unemployed people in the UK. But, of course, we still have that wage squeeze is getting worse. I don't know if to celebrate this or not.
Well, it depends. If you are looking for a job in the UK, you could find a job potentially, but it's the skills that is missing, which is why the data released this morning by the Office for National Statistics has had a mixed response. Yes, yet again, unemployment has fallen. It's fallen in the first 3 months from 3.9 to 3.8%, which should be a good thing. And the fact that there are 1.29 million vacancies on record, which is absolutely unprecedented. But again, going back to the Bank of England, they have forecast that, yes, we can expect more of a dip in unemployment, but it is likely to peak in the coming months. Why? Because we know that the British economy is currently going through a turmoil because of the cost of living crisis. People are not spending more. If people are not spending more, people will have to lose their jobs. So even though at the moment it's good, again, Innie, when we're talking about ONS data, we're always looking in the rearview mirror. We're not looking further ahead. So, yes, mixed reaction. Nice time to get a job if you have the right skills, but how long are you going to be able to sustain that job if there are not enough people coming into the services industry, coming into hotels, coming into restaurants, going out and about in London? We are likely to see job losses in the near future.
Yeah, Julian, I think one of these days we're going to have to sit down and create a way to talk about inflation, not just from the rearview mirror, but, project it, I think that's an assignment for us to do. Let's see the markets now. We see that Walmart has reported quarterly earnings, and it's lower than expected, at this time. So what else is happening in the market space?
Well, domestically, the FTSE is actually continuing its rally. It was doing very well yesterday. It continues to do well today. Lots of airlines and commodity stocks are flying high. The all-share is up by 0.89%. The FTSE 100 doing well too, at 0.82% higher. And the FTSE 250, the domestic market, up by triple digits by 1.03%. Now, there is finally a rally on the British pound due to those ONS unemployment data. In the currencies market, the pound is up against the US US dollar by 1.20%, also up on the euro by 0.31%, and up on the Japanese yen too, Innie, by 1.55%.
All right, Juliana, thank you so much. I'll talk to you again tomorrow. Enjoy the rest of your day.
Thanks, Innie.
Let's move from the UK now to Asia, where shares rose on Tuesday as Hong Kong stocks led gains regionally. The Hang Seng Index surged 3.27% to close at 20,602.52 as Chinese tech stocks jumped. Tencent rose 5.26%, while Alibaba soared more than 7%. Meituan gained 6.24%, and Hang Seng Tech Index climbed 5.78%. Mainland China stocks edged higher on the day, with the Shanghai Composite up 0.65% to over 3,000, while the Shenzhen Component rose 1.23% to 11,230.16. The Nikkei 225 in Japan climbed almost 0.5% to close at 26,659.75, while the Topix Index rose 0.19% to 1,866.71. South Korea's Kospi gained almost 1% to end the trading day at 2,620.44, while the S&P AX 200 in Australia closed 0.27% higher at over 7,000. MCSI's Broadex Index of Asia-Pacific shares outside Japan jumped more than 2%. In the United States, now stock index futures were sharply higher in early trade as the market tried to bounce following weeks of sharp losses. Futures contracts tied to the Dow Jones Industrial Average jumped 400 points, while S&P futures gained 1.6% and NASDAQ 100 futures added almost 2%. Home Depot shares popped more than 3% in the pre-market after the home improvement retailer posted better than expected quarterly result. The company also raised its full-year outlook. Walmart shares, we talked about there with Juliana, dropped more than 5% in the pre-market after the retail giant reported an earnings that missed following pressure from rising prices. The company raised its sales outlook but lowered its profit forecast. Citigroup shares jumped 5% in pre-market trading after a filing revealed on Monday that Warren Buffett's Berkshire Hathaway added a nearly $3 billion stake in the struggling bank in the first quarter. Citi shares have underperformed the rest of the financial sector in the past 12 months. It's been down nearly 40%, while the financial select sector SPDR fund is off by 12% over the same period. Egyptian Petroleum Ministry is working to implement 3 green petrochemical projects with a total value of $1.2 billion. The 3 projects include $600 million biofuel production plant with a production capacity of 350,000 tons of biofuels from algae oil per year, expected to cut carbon dioxide emissions by up to 1.2 million tons annually. The second project consists of a biodegradable plastic factory with a production capacity of 75,000 tons, with investments amounting to $600 million and an annual reduction of 45,000 tons of CO2 emissions. The third project is a $50 million recycling project that would see used plastics converted to 30,000 tons of oil annually to make polythene mola, and adding that the project will cut CO2 emissions by 63,000 tons annually. Egypt is currently intensifying its efforts in the energy sector as it gears up for hosting the Conference of Parties to the United Nations Framework Convention of Climate Change, that's COP27, which is to be held there in November this year. In South Africa, Transnet Freight Rail has lost more than 15 million tons of freight volumes this year, ending March 31st. That's the first quarter of this year, after declaring force majeure due to irregular locomotive acquisition, maintenance problems, and massive cable theft on its coal line. Transnet difficulties to meet its targeted rail capacity resulted in bulk commodity miners of iron ore, coal, and chrome the three biggest commodities last year, losing revenue of 35 billion rand. Despite these operational challenges, Transnet expects to report a 1.6% increase in revenue to 68.3 billion rand, with earnings before interest, taxation, depreciation and amortization up by 21.1%. World Travel and Tourism Council's WTTC has its latest economic impact report, and it reveals that the African travel and tourism sector is expected to create almost 14 million new jobs over the next decade. The positive forecast from WTTC, which shows an average of 1.4 million new jobs every year, also reveals the sector will lead economic recovery in the region, with its annual GDP growth set to outpace overall economy for the next 10 years. According to the report, travel and tourism GDP is forecasted to grow at an average of 6.8% annually between 2022 and 2032, more than twice the 3.3% growth rate of the region's overall economy, to reach nearly $279 billion. That's 7.2% of the total economy. The sector's contribution to GDP is expected to grow 20.5% to $144 billion by the end of this year, and that amounts to 5.1% of the total economic GDP, while the employment in the sector is set to grow by 3.1% this year to reach nearly 22 million jobs. Now let's go to our commodities segment. Now, in the midst of the Ukraine war, one of the most affected commodities has been wheat, going by the fact that both Ukraine and Russia are major exporters of wheat to the world, and this has highly affected prices. Well, we have analyst Lawrence Mess now joining us from Victoria Island. He's an analyst with financial derivatives company to tell us what Nigerians are saying and what are some of the alternative that people are looking for to wheat. Hello, Lawrence. Good afternoon.
Good afternoon. Thank you for having me.
Good to have you, Lawrence. So the price of wheat at the Chicago Board of Trade has increased by 12.6% to about $419 for a ton. This price represents about 60% increase this year, and this is just this year. Can we attribute all of this to the war, or are there other factors that are driving this price acceleration of wheat?
That's a very insightful question. If we actually investigate dating back to last year, the price of wheat was actually steadily increasing, and this was as a result to post-lockdown effects where demand was excessively higher than supply, and as well as supply issues and logistics constraints, increasing freight costs. All of these were contributing to the increasing price of wheat. And then if you fast forward to the Ukraine-Russian war, which has seen 30% or so of the world's wheat exports basically slashed from circulation. But however, this isn't actually the only attributing factor for the current increase in the price of wheat. Recently, over the weekend, the Indian government has actually suspended the exports of wheat temporarily. This is as a measure to protect domestic access to wheat and also protect food sustainability in the country. India is actually the second largest producer of wheat, though not a large player in the export market. They were actually expected to fill the gap that was created during the Russia-Ukraine war. So all of these factors have come together to actually cause the stratospheric increase in the price of wheat over the past year.
Yeah, so Lawrence, wheat is used in making so many staple foods: spaghetti, bread, cakes. You know, some people use it as swallow here in Nigeria. Now, given this pass-through effect on prices that has brought about the shortage, I know we've been talking a lot back here in Nigeria about getting substitute for wheat. Have we discovered, you know, good enough for effective substitute to wheat, or at least, you know, to make some of these products that they're used for?
Well, yes, there are substitutes for wheat, especially in flour making. Some of these substitutes are rye, white rice, or brown rice. even sometimes potatoes and coconuts. Many a times, these substitutes are actually just as quality as wheat and are even healthier in terms of consumption. However, the main issue is the technology, the available technology that will be utilized in converting some of these substitute grains into flour. It wouldn't be safe to assume that the production techniques for these other substitutes or these other grain types would be exactly the same as the process used in making wheat flour. And as well, there would need to be adaptations when converting some of these substitute grains into the production of things like pasta and noodles, as you've rightly said. But to answer your question more directly, yes, there are substitutes. However, we're not sure to what extent these substitutes um, are being adopted into the mass production of flour and other consumable goods.
All right, Lawrence, but what are we talking about local production? What are people saying? What's the conversation around that?
Local production, to be honest, is not really good news on that end. Nigerian demand for wheat is actually somewhere about 5 million metric tons a year. However, reports on news outlets are actually saying that Nigerian production is just about 60,000 metric tons a year. So to put that into more context, it's largely about only 2 to 5% of our wheat demand that's actually produced in-house. The other 95 to 97% is largely imported, despite increasing funding campaigns and demand. Looking at what Nigerians are saying on the grassroots level, it's largely attributable to farming practices along the entire agricultural value chain, starting from research to planting to harvesting and to production. There needs to be a complete overhaul. So first, there needs to be adequate research into high-yielding wheat seeds that will also be resistant to climate change and pests. Then in terms of planting, there needs to be adequate irrigation facilities because wheat is planted during the dry season or harmattan. There needs to be insecticides and pesticides as well, and adequate infrastructure. And then in terms of production and processing, we need transport and storage. So it's not looking good.
Yeah, a whole lot. Yeah, a whole lot of investments obviously is needed in that value chain, you know, if we want to overcome this. And unfortunately, it's not something you do immediately and get the results. You do it and then you wait for a couple of months or years before you say. Thank you so much, Lawrence Mercy, analyst with Financial Derivatives Company, for your thoughts this afternoon.
Thank you.
And with that, we draw the curtains on this episode of Business Incorporated. We still have another date tomorrow, 1:30. Do join us then. I'm Ini John McQuack.